Great.
Good morning, good afternoon, good evening, everybody. Welcome to this episode of the Note Closure Show. Hope you're doing wonderful today because I have got a treat here. We've had some people talk about commercial real estate, commercial investing, especially an aspect of things. So I have listened to what you guys have asked for and what you guys have said you love. And so I am excited to have the managing member of Cash Flow Connections, the man, the myth, the commercial capital raising legend, Mr. Hunter Thompson, who has raised over $60 million. Him raising a third of that personally. So good afternoon, Hunter, man. Thanks for joining us here on the Note Closer Show.
Hey, thanks again. It's an honor to be on the program.
Hey, no problem, man. So you were out in sunny LA, loving it out there in the city of angels, huh? But let's talk about kind of what your focus is. And if I didn't do you justice, let's start off and let people, why don't you share a little bit how you got into where you're at right now and go from there.
Yeah, sure. So I think for a lot of people, when they're asked that question, a lot of people that come on your program, they probably talk about 2008. That was a big number. That was a big moment for me, but it wasn't for exactly the same reason. I was not investing in or focusing on financial assets at the time. So when 2008 happened, I was one of those unique people that said, look, there's going to be an opportunity here in financial assets. I didn't know enough to know where the opportunity was going to be, but I could just tell that, based on historical trends and being able to see stocks that were trading below their cash value, I knew there was going to be some opportunity. And so I really went all in financial assets, first focusing on stocks because that was what was most applicable. It was most readily available, and spent about 2 years just following guys like Warren Buffett, just basically investing in value stocks. At the time, you couldn't lose. And so there was a lot of opportunity there. Over the years, though, I started to really iron in what I was trying to accomplish financially. And it ended up being the same thing it ends up being for most people if you talk to them about their financial goals, which is having enough cash flow to pay off their expenses. The challenge is that's very common, but it's very, very not aligned with most people's investing strategy, which is basically investing in blue chip stocks. So I was kind of coming to that realization, and simultaneously, I had my major last straw moment during 2010, which is something almost no one talks about, which is the European debt crisis. And this was when the Europe struggled with something very similar to what happened in the United States in 2008, but in the European capital market. So banks froze up, people had challenges even pulling their money out of ATMs in certain circumstances. And I was watching CNBC one day, and I saw the pundits were talking about the Greece bond yields. And they were talking about if the Greece bond yields, the 10-year, remained below 7%, the S&P 500 was going to be fine. But if it went above 7%, the S&P 500 was going to collapse. I was just thinking, after all this work that I put in, studying these stocks and looking at balance sheets, how is it the case that something like this is playing a role in my financial well-being, let alone a significant enough role that people are talking about it? Everyone's talking about it. And by the way, for those of you that were paying attention at the time, the Greece bond yields, not only does it go above 7%, it went above 25% and above 30%. How would I be able to predict that something like that was going to happen? And how would I be able to mitigate that challenge? And those two questions were really what led me to focus on more straightforward investments, eventually leading me to real estate.
Awesome, man. So let's talk about that because I loved your bio. You've done some really great stuff out there. Why don't you share with everybody out there kind of what you've been your real estate focus?
Yeah. So the first investments I made, back during that time period, 2010, doing hard money loans. I think that on a risk adjusted basis, it was really hard to argue with those theses. There was just no liquidity in the market. So if you get a 12 or 13 or 15% return at a 60% loan to value, 70% loan to value, especially in a non-volatile market, I think that I would do those investments all day today. The challenge is those opportunities aren't really there in the same capacity because the market's basically corrected. You can do that at a different leverage point, but not the same leverage point. So as that market correction started taking place, I started to get introduced to the world of commercial. Now, if you're currently only focused on single family, something that I think that a lot of you will find interesting, I know you'll agree with this as well. I'm sure you've interviewed a lot of successful people on this program. You've probably never interviewed one that said, I started in commercial and it just wasn't for me. And now I only do residential, right? There's a lot of reasons for that. You do hear people go the other way. Scalability is one. The ability to invest in high quality assets is another. And I kind of found, especially in the syndicated model, it spoke to me very clearly in the sense that if I'm able to rely on other people's time, energy, and expertise, that is an incredibly valuable situation to be in, especially when you have a complicated asset class where there's a big difference between a mom and pop owner and a best in class owner. And that really is what's very compelling about it. If you can, with single family, I've made a lot of single family investments, but the difference between owning two and owning 2,000 is not that different in terms of your expertise, just my opinion. But with commercial real estate, man, if you have 30 self-storage facilities, you're a major player in the space. You have systems in place. You have a major advantage over someone that only has 2 facilities. So we use that advantage to our advantage as a passive investor.
Cool. I totally agree with it. We started off in commercial, still buy commercial assets. It just varies a little bit on when how the market's evolved and some of the stuff here. But yeah, I agree. It's nice to have those nicer quality assets. It's not, you don't deal with the joker brokers or some of the sub-secondary markets and things like that. It's pretty much straightforward. Plus, you've got more time to do due diligence and break down and go that route out there as well. And it's a smaller niche within the niche of what we focus on. So it's a beautiful place to be at, and it's well worth the time to take to get to know it.
Exactly. And I will say also, part of it's a personality test. I mean, some of it has to do with the fact if you're more inclined to control every aspect of your investment, the barrier to entry in a single family isn't that high. It's one of the reasons it's so popular. But I really like to work with people and interact with people that stand to gain or lose millions of dollars. And when you're working with that, you're working with high caliber individuals that have a lot of incentive to actually deliver on the promises. It speaks more of my personality. It's not for everyone, but I'm willing to give up some of that control for diversification.
Smart comments there. I hope everybody's taking notes on that aspect of there, because that's a great way to filter through see if somebody's really serious. If they got $1 million there or more on their own money online, it's definitely be a lot more serious about it. So is there a niche inside that commercial space that you guys really like to focus on?
Yeah. I mean, generally speaking, I'm looking for recession resistant assets. And the reason for this is that if you look at historically speaking, all types of real estate is going to do really well when the economy's booming. Every single thing is going to do well when the capital markets are loose and you can get loans and you can do all this. Everything's going to do well. So if you're looking at trying to balance out your portfolio, I want to identify asset classes that the demand is stable, if not inversely correlated with the overall economy. And there's a lot of examples out there. The ones that I find most compelling are mobile home parks and self-storage. Mobile home parks, I think a lot of your listeners by now are maybe familiar with that thesis. 5 or 6 years ago, when I was getting started with the business, that wasn't as common. But generally speaking, the worse the economy does, the more demand there is for affordable housing. I think that's something that we can kind of wrap our head around. There's a lot of really interesting things about that particular asset class we can talk about as well. But generally, that's the recession-resistant component. Now, with self-storage, it's not as obvious, but it's very compelling as well from a historical data perspective. People use the product when they're going through some kind of transitional period. And a lot of those transitional periods can be brought on by recessions. So you think about kids moving home from college unexpectedly, or having a job change, or getting laid off, or having to downsize. There's a big baby boomer population out there that is basically relying on Social Security as a source of income. The challenge is Social Security check is literally less than the average 2-bedroom apartment in the US. So you're seeing a lot of downsizing, which is creating demand for affordable housing and demand for self-storage, particularly in markets like Florida, where there's a large baby boomer population. So I'm looking at those and I'm saying, okay, if you're able to get a little bit of both sides, are you able to get that upside when the capital markets are booming, can raise rents more aggressively when the economy's booming, but when the economy corrects, you're able to get appropriate financing, still keep that appropriate financing, and get that cash flow. And as long as you can weather the storm, I think you're going to be in a good position there.
Yeah, I love, because I think the same thing a lot of times. I think it's a great way to weather that storm, recession-proof your portfolio, still have a asset that a lot of people are looking for and in need of. Like affordable housing across the country is getting tighter and tighter and tighter. And that's where the opportunities, I think, lie the most, especially in the commercial space. You're right. You said self-storage, great thing, because when people downsize, it doesn't mean they want to get rid of all their shit yet, right?
Yeah. Right. I mean, very much not the case. It's a consumer economy, and people historically do not want to do that. They will put stuff in storage that's worth $2,000, and they will pay $30,000 over many, many years just keeping that stuff in storage. It happens over and over again.
And the beautiful thing, you can set that stuff up on autopilot. You can set it up where it's automatically build monthly ACHs. It's very easy to easier to manage because you're not dealing with so many drama or toilets and tenants and trash outs for the most part. You know, pay, you know, stay. We put another lock on it, and you're often behind a gate that we can control, right?
Yeah, exactly. And I'd say that you're kind of touching on two different things there, but they meld together pretty well. So, I mean, first of all, people aren't supposed to be living there. So the laws are very favorable when it comes to self-storage in terms of the owners.
Right.
So you can put a lock on their facility very quickly within 30 days of non-payment, 4 days in certain states, and you don't have to go through a lengthy litigation process. Those things matter. When you're talking about building a portfolio, if you have 30 investments, 40 investments, even if something goes weird 10% of the time, that's something you're going to have to deal with on an annual basis. That's just not really as significant with self-storage. But you're touching on the other thing that you're touching on is that it's a relatively simplistic asset class structurally. You're not really offering that much in terms of amenities. However, this is a really important distinction. There's a misconception out there that because it's simple structurally, that it's a simple to manage business, meaning that everyone's mom and dad thinks that they can just go and do it. And when you do that, you don't have the systems in place to optimally run the facilities. And the truth is, this business operates much more like a business than it does a commercial real estate asset. There's so many ways to add value. I mean, a perfect example, one that I try to give as frequently as possible because people should know about it, is leveraging relationships with related businesses. One of those is truck rental companies. Mm-hmm. So we have a relationship to our sponsors with U-Haul. We can buy properties based on their in-place income. And then as soon as we have the property, call our contact at U-Haul. They park 50 to 40 trucks in our facility, and we rent out the trucks with the tenants when they're moving in and out. Now, I have personally invested in properties where that one line item has gone from $0 a month to $3,800 a month directly to the bottom line. If you're looking at it on the cap rate basis, you're talking about $600,000, $700,000 of equity added to the property. But, and this is where the conversation starts to turn a bit, but we're not focusing on that side. We're looking at the other coin of that. What we're looking at is that's how much protected we are in the event that there is some kind of correction. So on a risk-adjusted basis, you're not doing capital expenditure, you're not expanding the facility, you're not going through the risks and uncertainties of development. You're just implementing a strategy. And that's a gold mine as far as I'm concerned.
Is there a size of the two of mobile home parks or self-storage as far as units or size of the asset that you think is a really great sweet spot that's maybe not too small? It's big enough to be worth the time, but not too small to be just a pain in the rear where it's below where you want to be.
Yeah, with self-storage, we like to see 400 units or 50,000 square feet. That is when you start to see the advantages of the economies of scale, because our strategy is to have an on-site manager there. And so that manager is going to cost the same if it's 20,000 square foot, 50,000 square foot, or 100,000 square foot. So a typical deal that we may look at, 50,000 square feet with the opportunity to expand by 20,000 square feet, something like that, or convert some of those units, standard units, to climate controlled units. With mobile home parks, there's been a tremendous amount of competition in that asset class that's happened recently and in the last 3 years, I'd say. And so what we used to say specifically, we only want this amount of profile. We've had to change that to account for the market correction. So, but I'd say city water and sewer with 100 lots or more is kind of the sweet spot that I think is appropriate. 100 to 300 lots. I don't really like getting up into those massive, massive properties that are, generally located in California, Florida. It doesn't really, the cash on cash is not as compelling.
That makes sense. Totally makes sense. Well, that's good to know that aspect of things that people are looking out there. Because where do you think the market's going to go in the next 12 months? I know you're watching this and you probably got your opinion of it, but what I always like to ask those that are got their foot to the pedal and rocking and rolling, doing some things, because I'm looking at the market, I'm looking at things. I think there's going to be a big correction on some things, in different areas. But where do you see the market going?
Yeah, I mean, I think you'll probably be sympathetic to this. I think that there's a difference between what people say and what people do. And that's just across the board. There's a lot of people that have a lot of respect out there that are constantly pumping fear propaganda that are not positioning their portfolio in a way that would suggest that they actually believe that. That's really concerning to me. So, my main focus right now, because it's the mobile home park and self-storage business, my viewpoint guided me towards those asset classes. It's not just that we happen to have a business focused on those. I love multifamily. and would love to be investing in multifamily right now, but we had to change our strategy to account for market corrections, which, by the way, going back to the passive investment strategy, being nimble in that regard allows us to do that. If we were only operators, we would not be able to change that strategy. Oh, you're an expert in multifamily, 2 years, you're an expert in self-storage. That's why we leverage the partnerships that we have. But to answer your question most directly, when it comes to this stage of the cycle, protecting principal is the most important thing. Now, you've probably heard that a lot, but what you actually have to do that is 100% about debt. And I know that's what your whole business model is based on, taking advantage to some extent or another, people that took inappropriate leverage and couldn't pay that leverage. So we're looking at 60%, sub 70% loan to value. And I'm talking about as is value, like purchase price value. So when we do those strategies, like add the U-Haul component, that's further protecting the equity position. So in terms of the next 12 months, I'm interested to see, I think that we're well protected given the fact that we are at those relatively low leverage points. We have a fund right now that's about 58% loan to value across the fund. So our goal is not to maximize return, but really to protect capital and go through this stage in which prices are relatively inflated.
That's so smart thinking. It's yeah, those that have leveraged out every aspect or every bit of their asset, pulled all the cash out, all the equity out, stuff like that. If the market turns, they're going to be in the red, and you don't want to be in the red when you've got investors involved on that aspect, right?
Exactly. And I'm really looking forward to our conversation because I have a show as well, and I'm looking forward to having you on as a guest because I'm interested to see what you're seeing right now. Because as those default rates continue to play around these particular, you're going to be the first person to know. Anyone that's focused on debt, they're the ones that go warning, warning, because as soon as a bank says no, that's when the economy crashes. Mm-hmm. And so you're driving the whole operation.
Mm-hmm. Now, with we've got we had a lot of friends that are in the apartment space. Their goal is to go in, buy the asset with private capital, get the property regentrified, raise rents a little bit, and then hopefully get refinanced out in 3 years. And I think I'm like, you got to be careful because if you look back at what happened a decade ago, those refinance options weren't there unless you were bringing 20 to 25%. To the table, especially if the values drop and stuff like that. With your assets that you're taking down, is that a goal in the long run to get cashed out or hold and just operate for an extended period of time and keep bringing that cash flow in?
Well, I think it's important to be diversified right now, right? More than ever. And so I think strategy and risk profile is an important part of that conversation. Right. So when all comes down to debt, like I said, so if we have a balloon payment, we don't want all of our balloon payments coming due in 5 years. That would be not advantageous. We don't want them all coming due in 10 years. We want to have enough time to be able to add value and potentially refinance. But to me, refinancing is like the cream on the, right? That's like the ultimate goal. So we don't want to like really set that as an expectation. But yeah, look, if we can add value, especially if you're going through some type of capital expenditure risk, that's obviously the goal. 3 years, I think that's cutting a little bit close. I'd like to see a 5-year term as a minimum, even if you are implementing those relatively low risk strategies in terms of adding value to the property.
That's smart thinking there. I think that's a bright, because the opportunity that if you're going through something, you've got some time to get your ducks in a row to get refinanced out, not have everything hit at once, because we know that can all be the kiss of death in some cases when banks call loans due.
That's the big thing, right? That's the major problem of every major challenge regarding loss of principal in real estate. But I will say that actually brings up a good point, because we've talked about some of the benefits of investing in these asset classes. The risks also need to be really discussed. And the main one that I don't see being discussed enough, again, is debt. When you're in these non-traditional asset classes, mobile home parks are a perfect example. Self-storage is a perfect example. The real risk there, especially compared to multifamily, is that those lenders are not going to be able to solve those problems. Mm-hmm. Here's the great news. If you're investing in Austin, Texas, multifamily, I've been scared about the prices in Austin, Texas for quite some time, right? And I know you have as well. But at the end of the day, if you have a loan due, someone's going to be there to make that loan. If you have a 100-unit multifamily property that's in Austin, someone's going to be there. Now, if you're in a tertiary market in self-storage, there's a couple of lenders that we work with. The asset class has not fully matured yet. It's not as competitive because of that, which is why the opportunity is there. But when things go sideways, you need a network to be able to solve those problems, which is why taking conservative debt is so critical right now, as opposed on maximizing return.
Mm-hmm. Now, what's some of the ways that you find deals? Are you reaching out to self-storage owner associations, or you're reaching out to local brokers in the markets that you're liking, or the secondary markets that you're liking for the most part? What's been your strategy?
So the way that we're positioned as a company is to leverage partnerships with top tier sponsors, institutional quality sponsors that have a minimum of $100 million under management. So our actual deal flow comes with those relationships or through those relationships. So me personally, I don't reach out to brokers. I allow the sponsors to interact with them, and they leverage their infrastructure. Now, I do have deals that are sent to me from time to time just because of how we're positioned, and people know that's our focus, but it's literally a matter of us. I will review the deal, look if it's in the region of what we may be interested in, and then discuss it with our sponsors. That is actually an interesting, for anyone that's out there passive investing, it allows you not only to leverage those systems and those relationships, but also the liability and stuff like that. You don't have to be involved in the operational side of things to get the benefits of some of these asset classes.
That's huge, because I think a lot of people want to get in there and touch it and feel it and control everything. And the less that you touch, feel, and control, the happier you are as well, I would say.
Yeah, it depends on your personality, right? I mean, that's why I think debt is so attractive. You're able to, when you invest in debt, you're able to have kind of the best of both worlds. You can control the asset without actually owning the asset, really limits your liability in that capacity. And, I think that's a great play. And it's an important part of that whole conversation.
Well, and it's also one of the great things that we've done in the past. We've done this with some self-storage units. We've done some mobile parks in the past, is when we are reaching out to the banks that are financing those asset classes and things like that, and they've got something that's non-performing, it becomes a really kind of an easy conversation sometimes when we're discussing buying that debt and coming in as bringing in our owner operators, bringing in our teams help manage that. The banks are often really, really willing and able to finance that for you, or let you take over that loan subject to or assume that mortgage, provided you can get the owner operator or the borrower out of the picture. And that's not the case with residential loans. That's not the case a lot of times with other asset classes, but it is in the self-storage and the mobile home parks and some of those bigger number loans, $1 million plus, $3 million, $5 million plus. The banks would still like to keep the loan on their books. They just want to move it from the non-performing side to the performing side, right?
Exactly. Because look, that $1 million, $5 million, $10 million loan, that represents a problem for them. And they don't want that problem. They don't have the operational prowess and efficiency to manage that property appropriately. So they're looking for a friend in that instance. And so again, going back to the other part of the conversation, you got a friend instead of an enemy.
Don't start singing "You Got a Friend in Me." All right.
That's later. That's the closer.
Yeah, you're there in LA and you're Disneyland and talking about Florida, everything like that with multi-family or multi-home parks, stuff like that. That's a big area. What are there specific states that you really like because of everything going on in them for the most part with those two classes?
I mean, I would say the majority of the opportunity with the mobile home park business is in the Midwest. I think there's a combination of the laws. I think the combination of the economics of the particular markets. There's a lot of economies there where the affordability is just quite low. And so if you can have a property that's a mobile home park, you can see unbelievable multiples, which will allow for significant rental increases. I mean, Austin, Texas is a great example of this. The mobile home park business in Austin, Texas, you may have a lot that is 45 minutes or 30 minutes away from Austin, Texas, that rents for $550 a lot per month, right? And a surrounding 2-bedroom apartment may be $2,100 per month. So you're looking at that thinking, if these people want to live in this area, if they have a job, for example, that's close enough to this area where it's compelling for them to stay, you can raise rents quite aggressively before you start to get pushback from the competitive set, assuming the competitive set's a 2-bedroom apartment. And that's very frequently the case. Now, when it comes to self-storage, I really, really, really like Florida in particular as a state for a couple of reasons. I mentioned the baby boomers also. There's obviously great markets there with high median household incomes. Many of them, the state is physically surrounded by water. So what that means is that a lot of people there's higher income properties, first of all, right? But also you have people that have water toys that need to store those toys. So you can kind of balance that out. People talk about hurricanes. I think it's an important risk of the asset class. But again, the simplicity of the structure allows you to really recover quickly, and you don't see typically very much damage when it comes to hurricanes. I mean, hurricanes are categorically a challenge, right? People want to stay away from those. So we don't invest in flood zones. But when it comes to hurricanes, specifically with self-storage, Next time you see a big storm, you'll notice that the occupancy rates of self-storage are through the roof, right? So we don't wish that on anyone, but I'm just saying it's well protected at the downside.
Well, and that's true. It's relatively easy to build units on a self-storage facility. It's not as def. And the mobile home parks, one of the first jobs I had out of college was working for Palm Harbor Homes, actually. And, the modular homes are not the little cheap things that you blow, the big bad wolf can come blow down like they used to be. You've got some really nice built, modular homes that withstand storms. It's not like Hurricane Andrew years ago. There was a famous picture of this whole mobile home park that was wiped out, and one home was left in the middle, was a Palm Harbor home. Now these days it's different.
Wow.
It's easier to build. The ability to build fast if you're going to build on lots, if you're not renting them out as well, is really nice as well too. So yeah, that's,
what, I actually want to talk to just briefly, because you mentioned it's easy to build the self-storage facilities, and that actually needs to be, considered when it comes to risks of the asset class. So you'll notice, and this is kind of revealing the cards, but you'll notice that you never hear self-storage investors talk about replacement cost. And the reason for that is not advantageous. So with multifamily, you may find that there's a 50% differential if you're buying a property. So you're basically making the argument, it's so expensive to build this comparatively that we can raise rents. We don't have the worry about development coming right next door. It's not the case with self-storage. You can frequently build properties cheaper than you can buy them. So what you have to do is be very cautious about the supply-demand disequilibrium within the 5-mile radius that you're buying in. Typically, people will not drive farther than that. But you can estimate that. I mean, the rule of thumb that we use in the business, there's about a 7.7 square foot of self-storage in the United States per person. So if you're looking at a 5-mile radius, and there is only 3 square foot per person, you're in a really good market in terms of it could be the case that it's extremely undersupplied. That's a rule of thumb. It's not end all be all, but it's a good starting point. You can also find markets where it's illegal to build new self-storage facilities. And so then you're starting to paint the picture that replacement cost isn't the most important determiner, because you can build these things for relatively inexpensive.
That's 2 great numbers. Plus you have range of numbers, expense ratios on self-storage facilities substantially less. What, if I remember correctly, somewhere in the 25, 28% range?
Depends on what
less, depending on size.
Totally. And depends on how conservative you're being, and like if you're including the management fees or whatever. But you will find, conservatively underwritten deals, I think, 40% at a 50,000 square foot property, 40% would be reasonable, including the management fee. Not including the management fee, it'd be in that low 30 range. And that is like comparatively, like, let's say that multifamily, the standard is 50%, right? That's a pretty significant difference. And I would think that those 2 numbers are similarly comparative in the sense that a lot of multifamily properties are below 50%.
Right, exactly out there. That's such great stuff, man. Dropping some great nuggets out there for those that are interested in stuff like that out there. Now, you've also, tell us about Cash Flow Connections. Tell us a little about that. You got a training program and a workshop too, of some sort, right?
Well, actually, we have a conference that's coming up that is actually this weekend, and it's pretty remarkable. I've never worked on something like that before, and it is, there's so many moving parts. I would never have been able to do it without, my fiance is actually an event planner. And if you guys have seen the show Silicon Valley, where there's VC funded companies that have like these multi-million-dollar parties for like 8 people, and then like Kid Rock is like the special guest. That's like the kind of parties that she's been doing. Now, we're not quite at that level, so we divided her fee by about 100, and then the overall budget by about 1,000. But we're still going to have a great time. So the Intelligent Investors Real Estate Conference, if you guys look it up, depending on whenever the show is, if you can't make it this year, next year it's probably going to be awesome as well. Major speakers. I think we have about $5 billion worth of, the speakers cumulatively own about $5 billion worth of real estate. So really excited about that, for no other reason than to create something really special. I think that you'll probably, be sympathetic to this as well. The podcast community has completely revolutionized the education space when it comes to real estate. I had to go through networking event after networking event to get the amount of content that if you just listen to 10 episodes of your show, you're going to understand very, very quickly, because it's not a sales pitch. It's just literally content, sophisticated people talking about stuff. The challenge, though, and this is not something to be taken lightly, when things go sideways, you actually have to have friends to handle those problems. And you're not getting friends by just listening to podcasts. And so we're trying to facilitate those friendships, those relationships. So when you say, wow, what investor do I know that can solve that problem? That's going to come back to not just knowing that you have a problem or what the problem is, but being able to email someone and say, listen, we need 30 days and we need $1 million or we're going to have a big problem. There's people out there that'll solve all those problems. So right now it's good to build up that base, because when things do correct, everyone's going to need that friend. So it's good to be first on their list.
You've got a friend in me.
Exactly. That's my whole pitch. This is just a podcast about making new friends.
Talk about your podcast some more, Hunter. Talk about, because I've listened to some of the episodes. I've got it subscribed to it. Really, really enjoy it. And one of the things is when I have guests on and they've got a podcast, I like to go listen. And I was like, oh yeah, definitely got to have Hunter on here. Definitely.
Damn,
so
I really appreciate
about the podcast.
Yeah, I appreciate you giving the opportunity to talk about it, and thanks for the compliment. I have always learned through podcasting and audios. I listen to audiobooks. I don't really like to read physically. I think it's efficient, but also just that's the way that my brain works. And so I have built up a pretty significant network of pretty influential people. And I said, why don't we just record the conversations I'm having with them, put them on the internet? And that idea ended up being so much more fruitful than I could possibly imagine. I mean, the conversations alone have been a net positive, in the sense that if you had just told me, by the way, you haven't actually been uploading any of your episodes, none of them have actually seen the light of day, you have 0 listeners, it would still be an incredible benefit for me, because just being able to reach out to these people. I mean, I'll give you an example. First of all, I've talked to Grant Cardone. I've talked to Doug Casey. I've talked to a lot of high profile individuals, which is awesome. And it's cool to say. But I've also, I just got off a call with someone that was a consultant for the IMF. So when you asked me earlier, where do you think we are in the economy? My perspective on topics like that, which I don't have necessarily an expertise on predicting those things, but those conversations mold my perspective and how to prepare for that. So, if you guys are interested in commercial real estate, it's a fairly dense podcast. It's a little bit more detail oriented than those that are focused on beginners, for example. But again, like I said, if you listen to 10 episodes, you'll be where I was after a year of dedicating full time to education.
Yeah. And it's okay to name drop. What's the name of the podcast there for you? So there.
Cashflow Connections Real Estate Podcast. It's the name of the company is Cashflow Connections, and it's about real estate. So I just kept it as simple as I could.
And the best way to find information out on the summit is cashflowconnections.com as well.
Cashflowconnections.com. And so that in the conference is intelligentinvestors2018.com.
Awesome, man. We'll make sure and put some links on there and do some posts out as well for it there, and would love to have you on again down the road a little bit as well too, and keep us abreast of some things we get some things into from different banks and asset managers run some plays. So I think there's a reason we were supposed to connect originally on some of these assets out there, because I agree, it's all about your network. It's all about having relationships where you can pick up the phone and call somebody when you need help, because I don't think enough people ask for help earlier on in their pre-problem issues. You know what I mean? If you reach out, oftentimes most problems can be solved with just a phone call or discussion with a friend or a peer. So, Hunter, what's the best way for people to get a hold of you?
Yeah, well, you can find the website's cashflowconnections.com. If you enjoyed this conversation, you made it to the end, I'd be happy to shoot you a couple of ebooks. You can get those at info@cashflowconnections.com. Just email me, say you saw us on the show, and I'll shoot you a couple ebooks.
That would be awesome. Hunter, thank you so much for taking time in our busy schedule to be on the Note Closure Show, and we'll be in touch. All right, brother?
Yeah, I really appreciate the opportunity.
Thanks, man.
Thanks again.
All right, guys, that's going to wrap it up. Take advantage of those offers. Great chance to get some ebooks out there as well to add to your library. Info@cashflowconnections.com. Mention the show, and Hunter will get you taken care of and expand your commercial knowledge out there. Once again, guys, go out, take action, and we'll see you all at the top, everybody.